It's happening again. The conditions that allowed me and my partner to build a portfolio of hundreds of millions of assets is occurring again 18 years later. I am going to walk through and show you what is going on, the conditions, how to take advantage of them. This is something that we've been waiting for a long time. In fact, we didn't know that it would ever happen again. And the opportunity is massive. We are going all in. My partner and I are investing over 10 million of our own personal capital. We are gonna build what we already did again, except this time we're gonna do it way bigger. First thing, everybody, the last 3 years have been rough. Commercial real estate, but especially self-storage. In fact, just a couple years ago, self-storage was the lowest performing commercial asset, except for office. It has been difficult, and a lot of people are confused on why it was so difficult, especially compared to maybe 2008, when self-storage outperformed all other commercial real estate assets. We're going to get to that and show you exactly why. These difficult times have really made it hard for people to survive. And a lot of people got out of the biz, just disappeared. And capital is frozen. Transactions were gone. The setup that we are seeing now in 2025 is very, very similar. How we pulled our data was a combination of a lot of different sources combined with our own internal data across about 400 million worth of assets. We also looked at over 100 facilities that weren't within ours. This is something we've been analyzing for almost a year now. And the conditions have not only become right economically, but the industry. That's the big difference here. You see, you may have great economic conditions for a change in the cycle or for an opportunity, but if the industry isn't presenting opportunities, that really doesn't matter. Now, we need to understand just two basic things here. We need to understand the drivers, meaning we need to understand the driver of price and revenue. So what I'm going to do is we're going to understand really quickly here how we got to this point and how that actually sets us up. Then we're going to look at actual deals. We're going to show you what's actually going on right now and what we as a firm are doing. Not just talking about, not just saying, but how we are allocating money and how we are building our firm to take advantage of the situation. So you can too. The key is, it doesn't matter if you have hundreds of millions of assets, if you're just trying to buy one, it's all the same. And in a lot of cases, it's actually easier and a better deal right now to buy smaller assets. That's what's so exciting about this. You see, we got into business around 2004 or 5. We owned assets all the way through 2008. We owned, operated. Then after 2008, we changed up our management company or our company as a whole. And we had a thesis. I developed a thesis around what was going on, and we went in big. We're doing that again. Now, the drivers of self-storage value, both price and revenue or net income, which then creates value, are very affected by interest rates, more so than other real estate asset classes, because interest rates rising, that affected price of the asset on the market. Interest rates rising made cap rates rise, or values go down of all commercial real estate assets. But you see, storage got hit on the other side, that internal value, that revenue metric. The reason being is the housing market froze. Transactions stopped. People weren't moving anymore. They weren't losing their house, but they also weren't buying houses. The number one driver of new rentals, move-ins, is housing. So over the last 3 years, we saw values of the asset drop because cap rates went up due to interest rates and investors not being able to invest and get a return. Now, sellers, they didn't want to sell. They're like, we're not going to sell at this low price because a year ago it was worth, way more. Well, over the last 3 years, that made a huge gap between buyers and sellers, which we've talked about a lot on this podcast. Now, in 2025, as you guys that are active listeners have listened and followed along, you know that we've been talking about that's changing. We bought a bunch of assets at the beginning of the year. Well, now there's more assets coming to the market by far than not only the beginning of the year, but the previous 3 years combined. We're going to go over those and talk about those pricing, what's happened, and why. But over the last 3 years, that stop of the housing market created it so occupancies were going down. Now, unlike the past, operators were optimizing for occupancy. Why? Because of Wall Street, quarterly returns, and that's what investors looked at. So they dropped rates like a rock to try and get occupancy to stabilize at a high level so it showed well. Well, this really screwed markets. The big boys were plummeting rates. We're talking like 60%, and it hurt really bad. All of a sudden, all your new customers coming in were substantially less rent than the ones you had. So over time, it's just churning. The big boys were jacking up prices immediately after. 3 months later, they double your rate. And that's how they were making up for it. But this was all being caused because demand was dropping. Interest rates being at that level made it so we didn't have any new customers. Values were dropping, but also development stopped. You see, over the 3-year period of time, we still had new developments coming out because they all started when interest rates were low, when occupancy and rates were high. And so there was a huge plethora of new inventory hitting the market. A lot of it, people that weren't even in storage. They were developers or they were new and they were just trying to make a quick buck because they could flip it the moment they got done building and got a certificate of occupancy. We call that a CO. And they could sell it as if it was full for a skyrocket price, like a 5 cap. So tons of people were developing. Developments aren't you just start and you're done. These take years. So the tail end, even though demand from customers were dropping and demands from investors tanked, new developments were still coming out on the market. This made that problem worse. Now, a lot of those were holding on as long as they could. They got it out maybe a year ago is when they opened their doors. But they had to refinance at a much, much higher rate now. And the value went way down. More importantly, the underwriting that they were doing with the bank, rates, no, they're not nearly the same as they were when you started. So your revenue and your projections, because demand is down, rates are down, plus a higher cap rate, meaning value's down, and the banks are like, you got to bring money to the table. You got to give us money. Because we did the deal predicated on a valuation up here. The valuation is now down here. To make matters worse, the interest rate going so high dramatically increased their expenses, far more than anything they'd projected. So you have all these developments coming out, which exasperated that rate cycle. This is kind of where we've been at the last year and a half. Not fun for any of us. Very difficult times. The last 3 years have been some of the hardest in my career in this industry for over 20 years. Very, very difficult. In lots of ways, worse than 2008, which is hard to believe. But in lots of ways, it's true. So what does that mean? First of all, let's zoom out here, okay? And look at what we did and how we built our portfolio. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. Our portfolio, when we started what would become Bitterroot, as I called it, named after my favorite mountain range in Idaho, we started right around 2012-13, and we really acquired aggressively to 2016. Over that time, a lot of people looked back and said, oh, I wish I could have gone back and bought it, or that was the perfect time or conditions. First of all, it was not. You see, when we were buying assets, literally the next year, their value on the market was worth less. It was really hard. We didn't know that it would turn around. Occupancies were down. You couldn't get capital to invest. There were no investors out there. And there was nothing that would simply tell us, oh, it's going to be good later. No, that didn't happen. That didn't exist. It was nerve-wracking. We had to really focus on intrinsic value and not expect the market to make us. Over time, though, the same things that caused the issues in 2008 actually propelled the industry forward. Once again, something we're seeing, because developments have dropped like a rock because they can't get financed, performance is down, banks don't want to lend. That creates a contraction of inventory in the market. Now, remember when I said that it takes a while for that inventory to come out of the market? Well, the same thing to stop developments, it is to kick it back up. Meaning by the time the market recovers, it's years later until that new inventory that people are chasing will come to the market, exacerbating the upside. And that's a lot of what we saw. But more importantly, we were buying at depressed prices that were far below what the real true intrinsic value was. Now that spread of rates and occupancies returning, values going up, lack of demand, act like a catapult for wealth creation. It's important to know we weren't timing the market. We didn't know what would happen in the future. Nobody does. That doesn't exist. But I often say that my money does. And what I mean by that is the deals were so good because of the timing of the market that we were just buying more. Now, this is a natural part of having a good buy box, as well as just simply understanding the value of the assets. A lot of people have a very hard time understanding the functions that go in to create these circumstances. That's why we're here. This is what I want to talk about. Interest rates, as they went up, we had the twofold hit. This depressed prices. Nobody wanted to sell, but as 3 years went on, people have to sell for all the normal reasons. And developers have to sell, or they have to put money up, or they're going to lose the deals. So after waiting for so long, what happened in 2025 was all these assets are now coming to the market. Banks aren't extending anymore, and people are tired. They're done. A lot of these people were new into storage, and as they're telling us, we don't want to own this. I don't want to do this. I thought this was supposed to be easy, and I thought it was just supposed to be a quick hit. I mean, occupancy and prices always go up, right? And they're done. They don't want them. They're letting them go. They're moving on. They're like, we don't even care anymore. We thought we'd wait for years. Maybe it would just turn around, and that hasn't happened. I'm moving on with life. Now, the conditions today are very similar to that when we started our Bitterroot company and portfolio, which was an extension of the investing that we'd already been doing in smaller markets. We'd owned storage all over in little markets around the Northwest. Now, Bitterroot, we were moving up. We were going to buy bigger deals in bigger markets, and we were going to become a real storage company, a full-on management company, all in. And that's what we did. We went all in. And this was a scary time to do that. A really scary time to do that. A lot of people thought we were dumb. And a lot of people said, you don't understand. it's going to be worse. It's not going to get better. That was common. And that's common at the bottom of markets. Because you think, all right, first of all, it was an economic crisis, but it was more than that. We had political crisis going on. We had people that were bankrupt. No one knew what was happening. Layoffs everywhere. Companies going out of business. There was a lot of fear, and the future did not look bright. Now, when we look, though, at the economic drivers during that time, we go back and we take a look at what was going on. First of all, the housing activity was really, really low. So 2008, housing activity was like bottom of the barrel. Today, we're almost exactly at that point with housing activity. Interest rates were really high in 2006 and 7. After 2008, they dropped. Just like today, interest rates are really high. Housing activity has come to a halt. Now, when you look at occupancy and rates were down a lot in 2008 and 9, very similar to what we're seeing right now. And cap rates were generally high, very, once again, equivalent to what we're seeing now. What we saw after that point was, over the coming next 4 or 5 years, we had a stabilization of both occupancy rates. We had a stabilization of cap rates, or cap rates went down as interest rates got cheaper. And then housing activity started to pick up. Why? It picked up with interest rates. Now, when we look at these conditions, they're so similar for the self-storage industry. They are different, of course. No recession and no period in a cycle is the same. What's important to understand, though, is the drivers. Let's talk about why they're different. The first reason they're different is that interest rates will not drop as fast as they did. But they don't need to. What do I mean by that? I mean, in 2008 and afterwards, when interest rates went to zero, it didn't matter. Because even if your cost of money is free, but you can't give it to anybody, it doesn't matter what the debt is. So you may have had 0% interest. It may have been free money, but there was nobody to give it to. Nobody could lend. Meaning the interest rates went really low, but you couldn't deploy the capital, so nobody could invest, nobody could buy homes, nobody could do that kind of stuff. So even though interest rates were low, activity still took years. This time we see an inversion of that. You see, liquidity is at an all-time high. Money markets, everything else. Interest rates are way more sensitive today. So interest rates won't go down like they did after 2008, or we'd get inflation. But the effect of it would be very similar, because as interest rates drop, even a little, we see an immediate reaction. How immediate? We'll take a look at our portfolio. Now, generally speaking, to see a correlation between interest rates and activity, you really couldn't. Why couldn't you? Because you're doing things like advertising, you're marketing. So you could be gaming the market, right? You may not have a good, clear understanding. This is where something unique occurred. As we're trying to get ready to take advantage of this, we took a bunch of our assets, which we had tremendous equity in, and our return on that equity was very little. And we sold them at a really high price. The reason we sold them is because we could take that money and reinvest in assets at really low prices. How can we do that if assets are selling at low prices? Because we had an assumable loan at 4% interest rate. So to our buyer, it's a 4% interest rate. It's not 6 or 7. So we got a 4 cap and a really high price. That is where the opportunity for us came in this time. It wasn't like that last time, but this time we can sell really, really high at the same time that assets are trading really, really low. We got to take that. But what that meant was, as we were selling, we stopped a lot of activity in the assets per request of the banks and the people buying our facility. We stopped really advertising. That meant we had this portfolio of assets that the fluctuation in move-ins was purely just on market demand. Just people came in because we had more market demand, or they didn't. We were not shooting up ad spend or anything else. Very unique. What we saw is we saw a correlation that I've never seen before. I could track move-ins based upon interest rates, which we all know interest rates go down, it goes up, but we could do this at just 10 basis points, meaning that as we looked over with a 3-month lag, we had a 95% confidence level of move-ins on a 10-point basis drop. Every 10 points, we had X amount of move-ins go up. And every 10 basis points that interest rates went up, we saw that many move-ins less. It was shocking to me because it was so exact. It was wild. We didn't see this in 2008. We didn't see this in other times. The reason being is there's money, there's people that want to borrow. So when interest rates move down, they act. They act fast. What that tells us and what that means. In 2008, we had a long time to buy up assets, and we had a long time to negotiate, and buyers weren't coming out of the market. Years. That won't happen this time. We now got the announcement that the Fed is changing. We're going to more of an easing. Interest rates are not going to drop fast, but they don't need to for us to see the equivalent effect. This is why the conditions, although not the exact same, the outcomes are so similar. Now, the conditions overall are eerily similar. Once again, as you could see as we tracked, as we look forward and project out in the coming years, we are not projecting interest rates dropping like tremendously. We don't expect interest rates, and particularly a 30-year mortgage, to go below 5%, maybe ever again. Maybe it'll just go to 5.5. We don't need it to, though. We don't need interest rates to crater. For us, moving back to just a normal is tremendous and has a massive effect. And we saw this. This is something we could measure. That's when the industry part came in. Right now, we have assets that we are currently under contract and we are buying. Let me share with you the similarities from after 2008. Right now, we're going under contract on an asset that's right around 3.9 million. A new build. Times have changed. They got destroyed. They got hurt, just like everybody did. It's not like they were alone in this. And they're selling the asset at just under 4 million, which would cost to build today well over 6 million. Well over 6 million. Probably 8. They're selling it at the same price that in 2015 we were developing assets. That's wild because rates are not what they were in 2015. They're higher. The market isn't what it was during that time. So we are buying facilities at the same relative price level that we were back then. Yet we're way further in the future. The cost to build is easily double, if not triple, what it was back then. Now, some of the assets we're not buying anywhere like we were back then. They're 2x the price, but they are still substantially under the cost to build, like $90 when to replace it, it's $160. We also have owners that are getting out, but they have to sell it at a high cap rate, a cap rate that is more in line with an 8 cap, which is what we were buying back then. This is a unique time. And these opportunities, once again, we've been waiting for over 18 years. They don't always come around. And storage, I don't know when an opportunity like this will come back around for a few reasons. First of all, they've now learned. They didn't learn this in 2008. In fact, it was the opposite. In 2008, people got this idea that self-storage was recession-proof, which drove me wild. Any of you that listen to me know, that made me so upset. A large amount, talking 80% plus of all funds in self-storage came after 2018. No one had ever been through a down cycle, ever. The majority of the industry, funds, private equity, on and on and on, all the new investors, they'd never gone through it. all they heard was that it performed well in 2008. Well, did it perform well? When they say it performed well, what they really mean is it was the lowest defaulting asset. But you also have to realize that during that time, the average debt to equity was 50% or lower. Most of the assets had no debt. That's why they did so well. It wasn't because we were occupied and getting moved. No. We were buying assets that were 65% occupied. And we did not underwrite to go to 90% because that didn't exist in the market. And we didn't know that it would ever go up there. We'd underwrite to like 80% if we could get it there. And it would fluctuate massively. The assets weren't doing great. They just didn't get hit as hard as other asset classes because they had less debt. That was a hard lesson for a lot of people to learn. So they will remember this, and the industry will change. That's why we believe we have around probably 12 months to do what we did in 5 years. That's going to be the major difference. The market will react way quicker. Investors will come back way faster because of liquidity. But at the end of the day, we have storage facilities that are multi-story Class A in markets like DFW, Texas, we're talking Fort Worth, Dallas, that we are buying at cost that we could never replace these for. We couldn't have even replaced these for 10 years ago at the cost we're buying them today. The price is very much aligned with downturn in a major way, but back in those cycles. This is a window and an opportunity where intrinsic value is higher than the price that you're buying it at. That doesn't come around often. So we're allocating mass amounts of our own capital and with investors as we are buying up these assets by the end of the year. Our firm is going all in, and we're going all in a really big way. We've been through this. Now, for everyone that says, AJ, this time it's different, you don't understand. No, I do understand. And I do understand the dangers that exist. Hence the reason why it's so important that you buy them at these prices. That way the intrinsic value is so low that it can be worth it. Meaning we don't expect the market to go back up and make that value appear. We underwrite as if cap rates don't change and market rates don't change. Our 3-4 year underwriting, we don't increase market rates at all. We don't decrease cap rates and say values are going to go up. No, we're not buying like that. We're buying as if in today it's a good deal. Of course, we all know that 10 years later, right, prices go up. That as we don't have development, demand rises, that interest rates will eventually go back down. They don't need to go down a lot, but the housing market will eventually start moving again. People will start moving again. There's political turmoil. There's mass amounts of government debt. All these things we know and understand. The key, though, is we can see the problems, but very rarely can we see the solutions. You have to understand that although there's a lot of issues in the economy, politically, and in the world, when you go back to 2008, not only was it very similar, it was worse. A lot worse in a lot of ways. There is always things when you have downturns, shifts that will look like, how do we even get out of these? It will look like it's over. This happens, but it's not over, and it won't be. The United States, with all its issues, is well, to be frank, the best house in a really ugly neighborhood. Capital is moving in like crazy. You have other countries that are facing literally defaults right now, like France, Italy. They can't pay the bills. Investors flee those. Economic activity flees to the United States. We have our problems, but they're nothing like the rest of the world, which is shocking because we got a lot of them. And they're also exasperated in hard economic times. That's what we're seeing and feeling. But we do get through these things, and the future does get brighter. And we're not underwriting for the future to be brighter. Now, we are very picky on where we invest due to these things. We do believe that there is a tale of two countries. Some states and some locations are doing so much better than other locations, it's hard to believe they're in the same country. It's wild when I go to certain places in the United States and I'm like, this is unrecognizable. This is so different from the reality that I and a lot of Americans live. That's hard to see, but also is a function of the United States. People vote with their feet. They move. Capital moves. So we go in those places. We go to where the political side is more stable and they're business friendly, and they have things like good housing prices and growth, all those kind of stuff. We really, really look at that, and you need to be careful with that. But the biggest risk for self-storage investors is self-storage. You have to be very careful not to invest in areas where new supply is coming or it will be oversupplied. So be careful of the risks because they're real, which we are. Those were real in 2008 as well. When we are looking at the future and the outlook, though, this is probably the best time to invest in self-storage in the last 20 years. Which is funny because everybody goes, oh, this is so bad. Everything's so bad. It's the worst time ever. And that's how you know it's good. That's how you know it's time. It's counterintuitive, but it's true. Because you buy when it makes sense at those depressed viewpoints and timeframes. And then you own it at that value, which works then. Not expecting, not guessing, or thinking that things will turn around. You buy on the fundamentals. And then you work on the asset in a very real sense. You operate it. You run it well. And then over time, you get the leveraged effect of the markets and the economy moving forward, changing. Whatever that time frame looks like, which we don't know. When you haven't been through it, it's really hard to understand how much that leverage effect grows wealth and capital. I have, and it was shocking to me. I did not think 10 years later that what we were doing at that time would end up, because it was hard to imagine at the time. We were just looking at cash flow, thinking, okay, we can offset income and different things like that. The wealth explosion that occurred and does occur through these different cycles, I hadn't experienced like that before. And so I didn't know. Our firm right now, we are taking investors. We are building it out. I've been hiring all year. We're pouring money into the firm, pouring money into the assets, and we will continue to over the next 12 months. First tier markets, growing second tier markets at prices that are the most attractive that they've been in since 2008. I am so excited about right now, even with the challenges that we face. But for storage, the hard part we've been through. The last 3 years were the hard part for storage. We suffered through those. We felt the full impact and change in the economy. Now we are on the other side. Markets are stabilizing for us. Other markets like the stock market, totally different, right? Just because the stock market is up doesn't mean real estate's up. In fact, lots of times it's inverse of that. That's what we're seeing now. We were hit hard, really hard. It's stabilized. Sellers are selling. We're able to get those good deals that we weren't before, and setting ourselves up for what we call our Bitterroot 2.0, or we're calling our Heritage Fund. We're doing it again. If you guys want to know more information, you can follow the link below. But at the end of the day, you can take advantage of these times. You have to have a clear head, though. You have to create opportunities. I mean, you have to work with deals. It's not easy. A lot of these deals we're doing came to us off market. Some of these deals we've been working on for 6 months. It's not easy. It never is when you're getting good deals and prices are down, but it is so worth it. And we've spent the last 2 years getting ready, working on deals, and they're now coming to the market. We have more than we've ever seen in the last 3 years by far, more than 3 years combined. So now's the time to go. Now is the opportunity. Because if you wait for the outcome, meaning interest rates to drop or the housing market to pick back up, the prices will reflect the change in the market immediately. They already project the future prices. The good deals are no longer there. So you buy, understanding that at that price, everything you're fine. And you can wait, and it's okay. Fundamentals are key right now, and they set you up for the future. I'm happy to share more. We have a whole YouTube video that we're doing where I'm actually showing all the slides, kind of like all the data. We're posting it so you guys can see it. We can walk through it very step by step to make sure that you understand what our firm is seeing, what we're looking at, the comparisons. I want people to understand what's happening right now. In 2008, when we were doing it, everybody thought we were crazy. I did too, kind of. I was very concerned about it and worried about it. I didn't have understanding like I do today. Today, it's a lot easier for us to see. And it's a lot easier for us to understand the path, how to buy, how to extract value. That's what I'm sharing. And that's what we will continue sharing as we're doing it from our experiences. One of the deals that we bought just 2 months ago, a big development, brand new deal, the owner walked away from all the equity. Everything. We took it at the note. This is becoming common. Owners willing to sell at the new adjusted prices because they have to. It's a great time to be buying. And the great time to be buying and the opportunity comes because it's been so hard. Storage has been difficult and we've had to go through it. And so many are gone. So many people stopped looking into storage, stopped investing, funds leaving it. And it's right when everybody's gone that is the time to strike. So follow the link below. We'll show you and you guys can look at everything we're doing, how we're doing it. Watch the YouTube video. I'll break it all down. Make sure you guys are subscribing so you can see and keep updated because I'm going to update you the deals we're doing, how they're going, what's happening, how we found them, how we're securing them and buying them. Right now we have 40 million lined up and we're going to do 100 million by the end of the year. So 100 million in deals by January 1. I've had to staff up for this. We've had to really get ready. This isn't like we just decided today. We've been preparing all year for this moment. And we're going to take you guys along each step of the way. Let me know the questions that you have. What do you want to see? What do you want to hear about? Make sure you guys subscribe and please give us a great rating. Ratings really, really help. If you like the video, if you give us a rating, that gives us exposures and it tells me you like the content, so we keep producing more. And with that, everybody, thank you for being along this journey. And I'm excited as the end of the year goes and we're working our brains out, so if I survive, to keep showing you guys all the changes we're making and how we execute on it. So you guys can do the same thing and take advantage of what can be generational, lifetime changing advantages that do not come very often, just like we did over 18 years ago. Thanks, everyone.